Good morning, everyone, and welcome to our webinar, Tax Benefits of Long-Term Care Insurance, with AIM's Mike Anderson and Mutual of Omaha's Bill Beckett. This is Jordan, the marketing coordinator here at AIM. Today's webinar will be recorded and then later posted on our website. This does mean that all attendees will be automatically muted so that we get a quality recording. If you have any questions, go ahead and type them into the chat box and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure you get that answered. Before we get started, we'd like to invite you to join us for our next webinar on Tuesday, January 28th at 9 a.m. Pacific Time. Join Nisha Catron for ROI, Crush Your Goals, and Close the Year Strong. And with that, I'll hand it over to Mike and Bill so that we can go ahead and get started.
All right. Thanks, Jordan. Appreciate it as always. Jordan does a great job of pulling together all the behind the scenes stuff that makes it possible to do this, what appears to be seamlessly out there. So we do appreciate that. And we certainly appreciate Bill Beckett from Mutual of Omaha's Advanced Markets team joining us here today. Long-term care has been important for AIM for a long time. It's been important for Mutual of Omaha for a long time, and it should be important for agents because it's going to end up being important to their clients. One of the things that doesn't get talked about a lot is what Bill's going to talk about today, which is the fact that there are some pretty significant tax benefits available for folks out there, both individuals and business owners. And as part of what's going to be an ongoing series on long-term care insurance and why it's so important over the next several months, this is kind of the kickoff piece of that as we take a look at this tax thing. So with that said, in the aftermath of Ohio State winning the college football national championship last night, I'm going to turn this over to Bill, and he's going to take it through us. So Bill, take it away. Thank you.
Yeah, thanks Mike. Thanks, Jordan. Appreciate it. And good morning, good afternoon, everybody. And yeah, thanks for allowing me to talk about the tax benefits of long-term care insurance. You know, of course, look, we know if you go on claim with a long-term care policy, the benefits are going to be tax-free, right, generally speaking. But today we're going to look at some of the other tax benefits, you know, Mike has talked about long before you go on claim, or even if you never go on claim. These are the tax benefits of owning a policy and deducting being able to deduct the premiums that you paid into the policy. So standard disclaimer, right? We're not offering legal or tax advice. So to get started, one of the reasons that long-term care has tax benefits, again, related to premium payments that say, you know, life insurance, disability insurance, and some other vehicles don't have, is that long-term care insurance is actually treated as health insurance and taxed essentially the same way. And that's because that these benefits are available to employers, employees, spouses, dependents, and they're part of the HIPAA Act. So just, you know, kind of tuck that in your back pocket. So I mentioned it just a bit ago, long-term care insurance looks different than, say, life and disability because it has this advantage of the premiums being tax deductible. So how much can be deducted depends on who the payer of the long-term care premiums are and who the policy is on. And by that, I mean, it depends on if you're an individual paying your own premium, if you're a business owner, right, perhaps self-employed, or if you're an employee of that company and the company's paying on your behalf. One thing I'll point out, and I'll mention it again, within businesses, there's essentially two different types of businesses. There's basically C corporations, and then there's everybody else. And again, we'll get into that in a little bit more detail. But before we get into the specifics of what these deductions are, I think one thing to review quickly is the age-based eligible premium concept. Look, I'm sure you all know about this, right? The age-based eligible premiums. Now that we're in 2025, let's take a look at this year's numbers, and you can see them on the left-hand side of the screen there. These are the maximum amounts based on the age that can be deducted for LTC premiums. On the, sorry, they're on the left. On the right-hand side, you can see the numbers for 2024. The reason I put those up there is for folks doing their taxes now, obviously they'd be interested in the 2024 numbers. We have an advanced markets guide here at Mutual of Omaha. Mike, we could get it out to you guys if anybody's interested, but it has these numbers and a bunch of other helpful, tax numbers, I'll call them, that are good to have by your side. So we're going to look at the tax treatment of long-term care premiums. We're going to look at them with respect to individuals. We're going to look at them with respect to C corporations, and then we're going to look at them with respect to self-employed, which is everything you can see on that slide there. Okay, so let's start with the tax treatment for individuals. Again, this is someone paying for their premiums directly. This is obviously the most common, largest group of long-term care policy payors. Unfortunately, many of them probably don't get the benefit of the tax deductions on premiums that they're paying because they don't itemize their tax returns. We'll talk about why fewer people are itemizing today versus a few years back. But for right now, let's assume somebody does itemize. Then generally, premiums that they pay are considered medical expenses. Remember, we spoke about that earlier as part of HIPAA. And they would be added with all of their other unreimbursed medical expenses for the year. And if that total is greater than 7.5% of that taxpayer's adjusted gross income, AGI, they would get a deduction for anything above that 7.5%. Now, in order to get it, as you can see on the slide here, you have to itemize, right? And think of Schedule A when we talk about itemizing. Earlier, I mentioned that many folks don't itemize. Generally, this is true. However, I will say many folks, when they start to hit their 50s, 60s, 70s, right, the older they get, their medical expenses go up significantly, and then they start to itemize. Me personally, I had knee surgery last year, and I was shocked at the out-of-pocket expenses I had between the surgery, the doctor, and the rehab. Medical expenses, regardless of insurance, are going up significantly for individuals, and it's resulting in more individuals as they get older itemizing. One thing to point out here, if someone is paying more than the eligible premium, they can only deduct up to the age-based eligible premium that we saw on the last slide. For example, in 2025, someone in their 60s could deduct up to, I think it was $4,770. Someone in their 70s, $5,960. So the reason I say that, as a matter of good sales practice, always ask folks if they itemize, and perhaps more importantly, explain to them that maybe they're not itemizing now, but they may be as they get older, in particular, 50s, 60s, and 70s because of medical costs. All right, before we talk about business entities, let's look at why fewer people itemize nowadays. And the reason why we want to put this slide up is this is actually a question we get quite often. The answer is real simple. It's because of the Tax Cuts and Jobs Act, TCJA, that took effect in 2017. As part of TCJA, the standard deduction essentially doubled, meaning as a result, less people and less families itemized. In fact, according to the Joint Committee on Taxation, now over 90% of households simply take the standard deduction. That's a pretty low number. Looks good from a tax perspective, ease of filing, but if you'd like to take advantage of some of the perks of itemizing, some that we're talking about today, it could be an issue. Now, I will say one way to look at it though, and when you're talking with your prospects, is that if you add all your deductions and it's lower than the standard deduction, in a sense, you're still getting the benefit because you're getting this large standard deduction. In other words, it all comes out equal in the end. However, one thing to be aware of, this expanded or larger standard deduction of part of TCJA is scheduled to go away or sunset at the end of this year. I will say there are a lot of political pressures to perhaps extend all or parts of TCJA, Look, nobody knows what Congress will do, but there's been a lot of discussions about extending some of these perks in TCJA. If I were a betting person, I would bet that some things will sunset and some things won't. There's a lot of provisions in TCJA. But again, from a sales opportunity, if someone says, well, I don't itemize, so I don't see the value in the deduction anyway, again, I would say that long-term care premiums are a commitment, a long-term commitment. And as you get older, there is a chance you will take the standard deduction, but even if you don't, you'll win either way. Okay, so we just looked at individuals and know that they get the deduction if they itemize up to the age-based premium deduction limit. But now let's shift to business entities because this is a different story. And when you think of businesses, especially when discussing the deductibility of long-term care premiums, there's basically two types. There's C corporations and everybody else. And we're going to call everybody else self-employed. In that self-employed bucket, LLCs, S corp, sole proprietor, whatever, it's considered self-employed by the definition. So basically, we've got self-employed, C corp. These are the only two categories that we have to worry about when we're talking about LTC deductibility. So let's start with the self-employed. Who's self-employed? Well, it's really simple. Anyone that's not an owner of a C corp or involved in a C corp. As you can see, the slide reads individuals who are not sole proprietors, general partners, LLCs, and here's a big one, and have net earnings from self-employment. Sometimes we get asked, if somebody is more than a 2% S corp shareholder, how do they fit in? If they own more than 2% of an S corporation, they're not considered an employee, they're considered an owner. It's really that simple. So continuing with the self-employed, this is a large group. In fact, again, if you're looking at sales opportunities, remember, even if somebody's selling, say, Etsy or selling online out of their basement, and they report it on their taxes, guess what? They're entitled to the benefits of this premium deduction. The reason I bring this up again is because it really opens up potentially a lot of opportunities for you. In fact, many people have sole proprietor businesses, and if you ask them, do you have a side business or do you report a side business? They may not be sure because that business doesn't have a tax ID. If they're reporting any of that income on their tax return, they qualify as self-employed, and then they would qualify for these deductions. Again, the deductible up to the eligible premium as reported on their business tax return. So they have to have income on their tax return to be able to take advantage of this. Okay, so now let's look at the second group of business entities, C corps. C corps are treated a little bit differently and actually have even a better deal in a lot of ways. C corps can deduct for any owners. One thing I will point out, they cannot be absentee owners. They can deduct for owners' spouses, owners' dependents. They can deduct for employees, employees' spouses, and employee dependents. And they can deduct their actual premium, even if it's higher than the eligible premium. This is something nicely, it's a nice perk for C corps. Now, the eligible premium, right, in most cases, it does cover the actual premium. But say somebody has a very, very expensive, very elaborate long-term care policy with expensive premiums. If it's a C corp, they can deduct the actual premium regardless of its amount. So nice perk. I personally think if you're talking to anyone, if you hear the word C corp, you should think long-term care because they get a very nice deal with this. One thing I put at the bottom, sales tip. Ask business owners if they're looking for ways to get money out of the business in a tax efficient manner, especially C Corps, I guess all businesses, but C Corps, S Corps. These business owners are always looking for ways to get money out of the business, in particular at the end of the year. This could be a good option for them. Hey, why don't you take advantage of taking some money out in a tax efficient way by paying for long-term care premiums. While we're talking about businesses paying for long-term care premiums, we sometimes get asked, can long-term care insurance be carved out or offered to just a few select group of employees or executives? Look, the answer is yes. So offering long-term care insurance, to pay the premiums for a business can be selective, you can discriminate, and you do not have to offer it to everyone. But I do want to put a little caveat in there. I would suggest if you're working with a business and they want to offer it up to not just a few select individuals, but a very large group, not everybody in the business, but a very large group, they may want to work with their counsel or their lawyer just to make sure that they're not violating any ERISA rules. But generally, they can discriminate and they could offer just to a few select employees or executives without any issues at all. Okay, so we just looked at owners or self-employed of all businesses. Now let's look at employees that the company is paying premiums for. This is probably the best tax treatment out there. I don't think taxes get any better than this. In fact, notice on the slide, I underlined any. That's because employees of any business, C Corps, S Corps, LLCs, sole proprietors, fall into this category. The business can deduct the actual premium for non-owner employees. They're not limited to the eligible premium age-based limits. Again, the actual premium they can deduct. And again, it's true for however the business is structured. They can deduct the actual premium. This holds true also for spouses and dependents of employees. The business may deduct actual premiums for spouses and dependents. So again, really good deal. I don't think from a tax treatment perspective, it gets any better than this. So if you've got, businesses, for example, who want to offer something unique, right? A unique benefit to the employees, maybe they're looking for some type of handcuffs to keep valued employees with them. Long-term care premium payments for the employee, the employee's spouse or dependents can be a great way to go about it. It's funny, we get asked on a regular basis, someone will call in and say, hey, we have a business owner that would like to pay for life insurance for an employee. And of course they can, but the premium payment is going to be treated as compensation to that employee. We always tell them, hey, another way to think about it is why don't they think of long-term care coverage, because then they get a double benefit. They get the benefit of offering something really unique to their employee, and it's also deductible to the business. Okay, let's shift over from the tax deduction rules for premiums and just quickly talk about the taxation of long-term care benefits. In other words, what happens when someone invokes or starts using their long-term care policy and starts taking benefits? Generally, they're going to be income tax free, right? I think everybody knows that. But I guess it does require a little asterisk next to it. Reimbursement policies, the benefits are going to be tax free. Where you might have some benefits that would be taxable is where you get into an indemnity policy. If someone went over their per diem limit, there could be an issue. It would be very rare, but I just wanted to point it out. When it's an indemnity situation, then you have to look at the per diem amount. Anything up to the per diem amount, which 2025 is $420 per day, works out to roughly about $150,000 per year. If you're over that, then there could be a tax issue. Look, the good news is most carriers, to include us, will make sure, even if on indemnification policies, that you stay below that limit, but just wanted to point it out. All right, some other tax considerations and questions that come up. People ask, can you pay long-term care premiums from a health savings account? Remember, a health savings account, HSA, a lot of times it's called, allows individuals to save money tax-free to pay their medical expenses. Long-term care premiums are considered to be an acceptable tax-free medical expense, only up to the age-based premium limit, and only for tax-qualified policies. So this means long-term care premiums can be paid using HSA money. Next question, can you pay LTC CI premiums from a medical savings account, MSA? Yes, you can. An MSA is generally used by self-employed individuals. It allows tax-deferred deposits to be made into this account. Withdrawals from the MSA are tax-free if used to pay for qualified medical expenses, which long-term care insurance premiums are. Can you pay the premiums from health reimbursement accounts, HRAs? Yes, you can. If you're curious what a health reimbursement arrangement is, it's not the most popular. It's generally a group health plan that employers use. They fund it to reimburse employees for qualified medical expenses. But again, you could use them for these payments. Now, unfortunately, the answer turns to no with some of these other questions. Can you pay the premiums from FSAs, flexible savings accounts? No, unfortunately, you can't. Nor can you from cafeteria plans, right? Sometimes called Section 125 plans. Yeah, and the reason are, they're not eligible because these plans, they typically go in on a pre-tax basis, so it would be, it would look like a double dip if you were. Okay, let's talk about 1035 exchanges. So the Pension Protection Act allows 1035 exchange of an existing annuity or life insurance contract or a new one that includes tax-advantaged LTC benefits. We see this on a regular basis, right? Maybe someone's doing a 1035 from a life insurance policy into a better life insurance policy with the long-term care rider. The exchange must be done according to the regulations, but it's done all the time and it's allowed to be done. Additionally, the question comes up, can you do a 1035 exchange from a life or annuity directly into a long-term care standalone contract? Well, this also requires a little bit of an asterisk. According to the IRS, yes, you can. You could go from a life or an annuity directly into a long-term care contract. The Pension Protection Act, by the way, that was in 2006, the Pension Protection Act was signed into law. However, when it took effect, a lot of carriers were concerned about the idea of a lifetime pay 1035, right? Think about it, most 1035s are really just one-time events. With single pay policies, it was a little clearer. However, I'm not aware of anybody that still has a single pay standalone long-term care policy. So most policies that I know are annual BSP pay, and most carriers don't want the risk of just doing a 1035 into a standalone policy. So as a result, while the IRS allows it, I don't think you'll find a carrier that would do it. Just so you know, way back in 2006, the IRS did say, hey, they understand the situation. They're going to get back and look at it and give some advice and clarity on it. And well, yes, they've been busy because we still haven't got any updates from them on any exceptions to this. So absent of an answer, most carriers, including us, will not 1035 from a life or annuity into a standalone long-term care. The reason I bring it up is just to say, hey, it's legal, but nobody does it. More importantly, I want to point out there is a workaround for this. What we see a lot is a 1035 into a SPIA, and then that SPIA will generate payments to fund the long-term care premiums. From an agent perspective, it's two product sales, which is nice. But more importantly, it's a great solution for your client if they have, a cash accumulation life policy, or more importantly, if they have an annuity that they're looking to perhaps do something a little bit better with. There's going to be a little bit of taxation perhaps on the SPIA, but it's going to be very low, and it's a great option and a great workaround if somebody has older, annuity policy that they would like to get more out of. If you have any questions on this, reach out to us. We'd be more than happy to help out on it. All right, let's take a moment and look at return of premium feature on long-term care policies from a tax perspective. So let me read. Any refund on a complete surrender, cancellation of the contract, shall be includable in gross income to the extent that the deduction or exclusion was allowable with respect to the premiums. So what the heck does that mean? Well, some policies offer a return of premium, and the question always comes up, hey, that's tax-free, right? Yes, it is. Again, I'm going to put a little bit of asterisk next to it. Return of premium, on surrender cancellation is tax-free to the extent that it was not already deducted as an expense. So if somebody, let's say, took a deduction for the premiums, maybe they're an individual and they use that 7.5, over 7.5% rule, and if they got a tax break, then the return of premium does become taxable only for anything that they already took the deduction on. All right, gifting. Sometimes we get questions on gifting as it relates to long-term care premium and long-term care itself, actually. Can somebody gift medical payments? The short answer is yes. If someone gifts the medical payments directly to the provider, then there's no issues. Again, right now we're talking about paying for the long-term care, not the premium. Here's an example. Let's say somebody is receiving care and they don't have insurance. Someone, and it could be anybody, it doesn't have to be a relative. If they make the payments directly to the provider, they can pay as much as they want and they don't have to worry about gift tax issues, because this is an unlimited exception to the gift rule. And it does not count against anyone's yearly gifting exclusion, if you're familiar with that, which is currently $19,000 per year. Now, let's change it up a bit and say, instead of giving the money directly to the provider, they simply give the money to the individual, and then the individual pays for their own care. What happens now? Well, now they could still make this gift, but it will count against either their yearly gifting exclusion, which is $19,000 per year, or there's also a thing which is called your lifetime gifting exclusion, which is now almost $14 million. So it would eat into that a little bit, but they can do it. So that's paying for actual long-term care, the expenses itself. But what I really want to talk about was, let's look at paying long-term care premiums for someone else. This can be done, and it doesn't count against someone's annual gift exemption, as long as a premium is not higher than the age-based eligible premium. If it is, then they may have to use some of their annual exemption. Some people ask, why can't life or disability be afforded this benefit as well? And again, it gets back to we're talking about HIPAA regulations here now, so we get that additional benefit. I put just a little sales tip up on that slide. Talk to older folks about protecting their adult children by gifting premiums. We run into it all the time where older folks, they have, a lot of times we call it excess money, right? And, maybe it's IRA money, maybe it's just money in a brokerage account, maybe it's whatever. And they're starting to look for tax advantage ways, knowing that, hey, eventually this money is going to pass to their loved ones. A very, very efficient way is to have conversations with them and say, why don't you simply gift, why don't you pay for their premiums while you're still alive? because you can do that and avoid gift taxes. All right, state tax incentives. So most of our conversations have been focused on, right, the federal tax benefits when we're looking at these premium payments. In addition to a lot of these federal tax benefits, a lot of states have great incentives as well. Typically, these states that offer these incentives have an income tax, right? Because that's usually how they provide the incentive. I know in Georgia, for example, where I'm at, it's 25% up to $500 is a credit right on top. So look, I don't have time to go through every state. A lot of states have great incentives. You can check out the AAL, TCA, the American Association for Long-Term Care Insurance. They have a great site that will list what the deductions are per state. Speaking of states, it's hard to talk about long-term care without bringing up some of the state-based programs that are, Washington is in effect, or other states that have, discussions around it. So the only state that's right in force now is Washington, and that one got a lot of attention when it came out, right? The payroll tax to fund it's been collected since July 2023. I think it's about 0.58% on tax earnings. There's some carve outs, right? Like if you're self-employed, in some situations, if you're military, you could exempt out of it. If you have your own long-term care, you have the option to exempt out of it. The claims for this Washington program actually start this year. July 2025 is when they'll start. So why do I bring this up when it's just the state of Washington? Well, a lot of other states are looking at doing something very similar to what's being done in Washington. In other words, state-based long-term care plans, payroll deduction plans. And why are states looking at it? In particular, why are states looking at it knowing that Washington kind of got off to a rough start? Well, it's real easy. It's one word, it's Medicaid. Medicaid is very, very, very expensive. In fact, for most states, Medicaid is the single largest expense. We've seen studies, Medicaid.gov had one, and it said on average 28% of state budgets go to Medicaid. So it's a big item. And you can see why states are looking at any way to bring those costs down and control them, especially considering that people are living longer and long-term care costs are going up very fast. If these states can defer paying long-term care costs from Medicaid, they'll try. Even a few months worth or a year's worth, it helps the state financially. So, if you look at Washington's concept, right, it's to pay, I think, for a year's worth of care via their program. They're a little light on the benefits, right? I think it's $100, their maximum daily benefit. That's light. But again, the state is looking at it as that's allowing them to save money. So that's why you're seeing a lot of other states look at it as well. So stay tuned. I'll give you a quick update on some of the on some of the states. Washington just had an initiative rejected, which would have allowed residents to opt out of the program, even though it's in place. They were trying to allow kind of a second opt out that was rejected. California had a lot of momentum earlier on. There's been no movement from the governor, the legislator, or Department of Insurance since 2023. Now, there is new legislation in place. We may see something come out of California 2025. New York has passed actually two bills that are in legislative session. They're identical, but they're technically separate bills, one in the Senate, one in the Assembly. Again, very early stage. They've only been introduced. They haven't made it through. And of course, it's a new session just taking place. New York would be interesting because there's not a lot of products, a lot of carriers if they did pass something like this. And then there's also other states that are talking about it. There's Hawaii, Maryland, Massachusetts, Minnesota, Pennsylvania, all have something. California actually just came out with something today, but it looks like most of the bill is actually focused more on denying premium increases as opposed to a program, or they do mention a program a little bit. And there's also some federal early stage legislation. So a lot of activity, and of course, we'll keep you, and the other carriers will keep you posted on these updates as they transpire. All right, so real quick, I know we're running short of time, but an interesting thing happened to long-term care premiums as part of Secure Act 2.0, right, from a couple of years ago. When people think of Secure 2.0, they really think of retirement accounts, but there's a lot of things wrapped around it. One thing that did come out of it, effective December 29, 2025, so it's coming up at the end of the year, retirement plans can distribute up to $2,500 per year for certain LTCI premiums. Have to be what's called high coverage premiums. Any qualified long-term care policy will qualify for this. Here's the catch. Catch, maybe not a catch, it's important to be aware of. The distributions from qualified plans are taxable. So it's not like if you take money out of, say an IRA, you don't have to pay tax on it. You do. You can just take it out without the 10% penalty if you're under 59 and a half. So if somebody has a lot of money in their retirement accounts, let's say, maybe call it excess money, have conversations with them, ask them that, say, hey, do you have a lot of money in your 401k and your IRA? If so, why don't you think of taking some of that money to pay for your long-term care premiums? Another great tax benefit. This is limited to retired public safety employees. They can take out $3,000 per year, and they can use it to pay long-term care insurance. Now, so this is, again, public safety employees, think like police, fire, EMTs, the group like that. So they actually get a little bit more to take out if they want to. All right, partnership programs, real quick. I'm not going to spend a lot of time on this because you guys all know partnership programs very well, but I'd like to put a different spin on it. It's essentially an asset protection tool for those who may wind up going on Medicaid. Let me explain that. So look, I think all long-term care insurance is asset protection, because if you think of it, if you need long-term care and you don't have long-term care insurance, you're going to have to spend down your family assets to pay for it. So the question comes up, is self-insuring always the best thing if leaving something to your loved ones is important to you? Again, you guys know this better than me, but this is a powerful sales concept discussing asset protection as it pertains to long-term care insurance, right? When we talk about long-term care insurance, we always say that, oh, if you're talking to somebody and they cared for somebody, they feel it, they could relate to it, and long-term care insurance is important to them. But what if they've never experienced that? Perhaps have the discussion with them and ask them, hey, do you plan on leaving some of your assets to your loved ones? And if their answer is yes, say, look, you may have a problem here. If you need long-term care coverage, Medicaid's not going to cover it until most of those assets are gone. Why don't you protect those assets with coverage so you're in a position to leave, something to your loved ones? That could be the hook that may help with the sale. All right, so wrapping up, here's just some of the sales ideas we talked about. All businesses could take advantage of the premium deductions. C Corps get the best, and also employees of any business get the best. If people say, well, I don't itemize, so I won't get the deduction, this would be for individuals. Tell them, look, as you get older, chances are you may start to itemize because medical expenses are really, really high, and you may get above the 7.5%. Number 4, we talked about using a SPIA to fund a lifetime pay long-term care policy. If somebody says, hey, I've got this lump sum of money, I just like to invest it into a long-term care policy, we know that policies like that don't exist. So put a SPIA in front of the long-term care policy, and it could be a win-win for everybody. Number 5, leaving something for loved ones is very powerful. So when we think of asset protection, and maybe instead of saying, hey, this is asset protection, talk about leaving something for loved ones. Number 6, ask business owners if they're looking for ways to get money out of their business. Trust me, a business owner, if you ask them this question, it will resonate with them, because without doing it in a tax efficient way, every dollar they take out, they're going to pay, you know, ordinary tax rates if they're not a C corp on that, which gets high. And then lastly, a good sales idea, especially with older people. Hey, why don't you gift the premiums, say for your adult children, to people that you love? All right, we have this agent guide, and we can get out to everybody. It's the LCT tax guide. It lays things out very simply. Everything we talked about today, it's essentially here in this chart. So it's a great, you know, cheat sheet tax guide for everybody when we're talking about the premiums, deductibility rules for long-term care insurance premiums. And I just wanted to give a site. So we have a advanced markets training site, Gateway. A lot of the information we talked about is also available there, and here's the URL below. And here's our advanced markets team. I'm the guy on the far right, and we're, you know, more than happy to answer any questions that anybody may have. So yeah, that's what I got. Mike, Jordan, I don't know if there's any questions.
Well, let's check and see. I'm going to go ahead and unmute everybody to take questions. Since we didn't get anything in the chat box, again, as always, going to ask the folks that are on the call to mute themselves if they're not going to ask a question. You're certainly welcome to ask a question on any of the stuff that Bill covered here today. A lot of great information there. Important to note, it starts just by asking some questions. And as you can see, there's a lot more to it than you might see on the surface. And the bottom line is there's a lot of money at risk if they don't do something with this. We were having a conversation internally the other day. If you had a client that was 66 and they elected not to get a Medicare sup, just to take the base AB plan that you can sign up for, the exposure, if they had, you know, a trip to the hospital, the exposure would be relatively limited because the supplement is just exactly that. It's a supplement, probably less than $20,000 and probably less than $10,000 out of pocket for a $100,000 trip to the hospital. If you have a $100,000 long-term care event and you don't have something there to protect your clients, the exposure is $100,000. So this is it's a significant piece to keep in mind. It's worth having the conversation with folks because they don't understand just how significant it is, or they're just beginning to. We're finding out that a lot of folks in the last couple of years have had some sort of introduction to this, whether it be a family event or just paying more attention. Maybe they have a relative that lives in Washington or one of the states that's dealing with or looking at dealing with state payroll taxes. Could be any number of different things, and it does make it interesting to say the least. So no requests, no questions. So we're going to go ahead and wrap things up. As always, the marketing team is going to be following up with everybody on the call. If we've got you set up to write with us, you've got the proper contracting and stuff with Mutual of Omaha, we'll be glad to make that agent tax guide available for you as a sales piece. But the compliance rules dictate that you be fully appointed with the carrier to be out there running around talking to anybody about this kind of stuff. So that'll be a piece that we'll be taking care of today during the follow-up calls. So I'm going to go ahead and wrap things up. Bill, thanks for making your time available. I may see you down at ILTCI or out at ILTCI in PA. Not really sure what we're going to do with that just quite yet, but maybe we'll have a chance to connect and have a little bit more of a chat. For the rest of you out there, we appreciate you making your time available. We know it's a busy time Right now, a lot of things are going on, but we do believe that this is worthwhile information for you to have. So thanks, everybody. Going to go ahead and shut everything down now. Like I said, we'll be making some calls later on today. Jordan will process this presentation and get it uploaded to our website later today as well. Thanks, everybody. Have a good day. Bye now.
Bye-bye.